Hello, everyone, and welcome to week 3 of Business 7550 Personal Finance. Last week's video, in fact, I noted it online for you. I know it was long, but those two topics, to me, need explaining, especially because of the equations with the time value of money and everything. So hopefully this one won't be as long, but I don't want you to just think you're out here floating around on the internet with nobody just telling you anything, just learning from the book, because that's not what it should be. Remember, you can contact me via email or leave me a voicemail at my phone number, which is listed in Canvas for you. And I'll get back to you. I'm going to be checking in regularly with both email and my voicemails here in my office. So anyway, this week, week 3, we're going to be building off of what we did last week with the time value of money and talking about the different types of banks and stuff like that, like we talked about credit unions and everything like that. But this week we're going to be talking about credit and the use of consumer credit to include borrowing money on credit cards, borrowing money for loans and stuff like that. And then chapter 6, that's chapter 5. Chapter 6 talks about your credit bureau report and how important that is, and what happens if, unfortunately, hopefully it doesn't happen to you, but it does happen a lot of times, what happens with identity theft. That's chapter 6, credit bureau reports and identity theft. So what are we going to be doing in week 3? There are a lot of objectives. There are 4 objectives in chapter 5 that are listed in that weekly overview. Again, I don't want to insult you by reading them to you. And 7 objectives out of chapter 6. This week, as I reminded you last week, I want you to go back to chapter 1 and review all of the PowerPoints up through chapter 6 because I don't expect you to reread the chapter every week. That's just way too much. But if you hit the PowerPoints over, you will start to remember, so that when it comes time in a few weeks to take the final exam, it won't be like you never saw it. Concentrate on chapters 5 and 6, reading those in your textbook. We're going to work individually to complete the chapter 5 and 6 problem assignments, the chapter 5 and 6 chapter quizzes, and the continuing case study for chapters 5 and 6. And then we do have a group discussion that the initial post is due by Wednesday, and at least 2 replies due by Sunday. Next week, we're going to move on to chapter 7 and 8, and we'll take test number 2. So it's moving pretty quickly, because next week we'll be halfway through the course, which it seems amazing to me that it's here already, but here we go. So let's take a look at chapter 5, consumer credit. Like I said, there are 4 learning objectives that we want to cover. We want to talk about the responsibilities, importance, and cost of credit, as well as the options available for us accessing credit. We're going to evaluate the features, benefits, and disadvantages of many types of credit cards. We are going to describe the mechanics of obtaining and repaying student loans. As a college student, you may have already obtained a student loan, but let's talk about what you have to do to maintain it, and to what happens, more importantly, when it's time to repay it. And let's look at the dangers. It says drawbacks, but it's dangers, and the benefits of payday loans, title loans, rent-to-own credit options, and identify some alternatives to that. Okay, so let's just take a look at generally what is credit. Credit is defined as an agreement in which a borrower receives something of value now and agrees to repay the lender at some date in the future, generally with interest. Remember, we talked about interest last week. Interest is the cost of doing business. A bank charges you interest on a loan because they're here to make money off the money that they loan. It's the premium, it's the amount that you pay for the privilege of borrowing the money to get what you want now, instead of having to wait and save up for it and then pay cash for it. That's always an alternative, but a lot of people, especially in today's world, it's not an attractive alternative. where do you normally get credit? Well, one of the oldest ways of getting credit is to approach your friends and family and say, hey, can I borrow $20, or can I borrow a little bit of money? Can I do this? And we'll talk about the advantages and disadvantages of that in a moment. A general purpose credit card can either be secured or unsecured. A secured credit card basically it almost functions more like a debit card than a credit card, in that you have paid in money to a credit place, and then you can use the credit card for up to that amount. Perfect example is if you've ever bought a Visa or a MasterCard gift card for somebody, and let's say you put $50 on it. The credit card is basically worth $50. Now, they can go and put some more money on it if they want to, but it's not going to give them more than the $50 that somebody has already paid in. So it's a credit card, but it behaves more like a debit card. Unsecured, a general purpose credit card would be a Visa, MasterCard, Discover, American Express, where you can use it for whatever you want to buy it for, and there's usually a limit on how much you can borrow, and then you pay it back either all at one time or month to month in payments. But it's a general purpose credit card. No, Visa doesn't tell you what you can and can't use it for. The businesses either accept the Visa card or the MasterCard, or they don't. So it's just a general purpose credit card. Sorry. That's different from a store credit card or like a gas credit card. For example, a lot of people start out life when they're building credit in their independent stage of life. A nice safe place to start is with a gas credit card. You get like a card for BP or whatever, and it's good at the gas station. You're not going to go off to Kohl's or somewhere and go on a shopping spree with it, or to the mall or wherever you go, or Amazon. But you use it for that particular purpose. It's to get gas at the gas station. Now, you can buy snacks at the gas station. Done that. But it's for use with that particular store. So, for example, a Lowe's credit card, if you're into home improvement, you can use that card at Lowe's, but it's no good at Home Depot or at any other place, Target or Walmart. It's for that store. So it's credit from a particular business, and they know that when you spend money with that credit card, you're going to be spending it with them. We're going to talk about some depository institutions where you can get credit, like your bank or a credit union, which we talked about last week. And lastly, or not least, but more dangerous, we're going to talk about finance companies, that's their job is to lend money. A lot of times we do that for auto loans. And again, we're going to talk about some payday loans and stuff like that. So let's talk about friends and family. This is, generally friendly money. The advantage is you don't usually have to turn in a formal credit application, and they're not going to check your credit. And generally, if they charge you interest, it's a low interest rate. Depends on how much money you're borrowing. Most of the time, they're not going to charge you an interest rate. You borrow, let's say you want to go on a cruise and you don't have all the money, and you go to your mom or your dad or your grandmother or grandfather, somebody, parent, guardian, aunt, uncle, and you say, hey, I'd really like to go on this trip. It's a once in a lifetime situation. Maybe it's a study abroad, and I need $1,500, and I could pay you back. I just don't have $1,500 in a lump sum right now. And hopefully somebody in your family would be like, okay, I can do that. Can you pay me back $100 a month? Or maybe $120 a month, divided up into 12 payments or 3 payments or what have you. And you set up some payment plan, and generally they usually no interest is involved. Some interest might be involved. Depends on your family, how cutthroat they are. Common uses for friends and family money would be a first car. My best friend just went through this last week. Her son needed a car. He's working now, and he needed his own car to get around. And so they went, and she helped him get the car, and he's going to pay her back from his paychecks. Another common use might be a down payment on a first home, or money when needed quickly. Like I said, an opportunity pops its head up, like I said, a study abroad trip, or a quick cruise, or something like that, where you're like, oh, I didn't have time to save up for it. Can you help me out? The disadvantages of using friends and family for money is if you don't pay it back. And I'm telling you, people will, your friends and family, because they love you, ironically, these are the people that are going to get screwed over when it comes time to not pay a loan back. You will pay a loan company back because they're going to call and get your wages garnished and all these kind of things. But friends and family, for some reason, people have a tendency to go, oh, auntie or uncle will understand, and then all of a sudden your family relationship is ruined because auntie and uncle don't understand, or they pretend to understand but secretly they resent you. And then your relationship with them is damaged. So if you go the family and friends route, you need to be just as disciplined with them as you would be were you borrowing money from the bank, because you're ruining your reputation, your friendship, your relationship with perhaps with a relative. And that's really a sucky way to go about doing that. I mean, you want to be able to look them at the face at the family reunion and not have harsh words and all that kind of stuff. It can also cause financial hardship on the lender, because a lot of times they love you, they want you to get what you want, so they might give you money that they really can't afford to give out, but because it's you and they love you, they're going to do it. And because it's a private transaction, there is no public means of tracking it, so it does not help you build your credit record. In other words, you borrow the money and you pay it back perfectly on time. If you went through a bank or a credit card or something like that, there's a transaction record that's part of your credit bureau report, which we'll talk about in chapter 6. But a private transaction like that, it never makes it to the credit union and all, not credit union, the credit board, so it really doesn't help you build up your credit. If you go that route, and I have been on both sides of this, it may sound harsh, but this is honestly the truth. Go ahead and have a contract written out. Have everything in writing. That way everyone is clear on what the expectations are. That way you, if you're the borrower, you know when they expect their money back and how often they expect you to pay it back and how much they expect you to pay it back. And if they're charging interest, how much the interest is, just like at a bank, right? So you know what to expect and they know what to expect. If you're the lender, because I've been both the borrower when I was young and I've been the lender now that I'm a little bit older, it just keeps everything on an even keel. It doesn't have to be huge. It's just something in writing that you have a copy of, they have a copy, and it says, here's how much money I'm letting you borrow. Here's how much money I expect back in a payment. Here's how many payments it's going to take you to pay it off. And this is the day of the month on which I expect my payment. And have everybody sign both copies. They get a copy, you get a copy. If you're borrowing, treat this as one of your most important payments. Because while it does not affect your public credit, it can severely affect your private credit with your friends and your family. And in many ways, that's way more important. I'd almost rather take my public credit take a hit and have a bank go, well, this person can't pay anything back or whatever, or they're slow paying it back, rather than having my whole family know that I borrowed money and didn't pay it back. It's your reputation. And if possible, if it's a fairly large loan, please try to refinance with the traditional lender if possible and as soon as possible. So let's say it's a first car. My friend she financed I think it was $12,000 for the car. My advice to her son would be, as soon as he could, well, if he's going to pay his mom back, make sure he pays his mom back. But if he's not going to pay his mom back, as soon as he could, he needs to get a loan through a lender and give his mom the money back. Why? Because, first of all, he's off the hook with her, And second of all, that public transaction through a lender is going to help him build his credit so that he's not just paying the money back and then it's not reflected on his public record. So it's just a good plan. General purpose credit cards such as Visa, Discover, MasterCard, American Express. The advantages, they are widely accepted. If you go most places, even outside the country, a lot of places accept Visa, MasterCard, American Express. There is, it does build your credit record if you have a positive experience where you pay off on regular time. There's buyer protection. So if you buy something through your credit card, like your MasterCard or Visa or American Express, and let's say you order something online and it either doesn't come at all, or when it gets there it's broken, or it's not what you expect it to be, it's somehow not right, you have the power of the Visa, Discover, MasterCard, American Express company behind you to get it made right. It's good for record keeping because you get statements just like from your bank. And you can also get advantages such as travel miles. One of my cards gives me, it's my American Express, it gives me miles for air flights. Or cashback. I mentioned in the other video, my MasterCard is through BJ's Warehouse, and I buy gas and dog food mainly there more than anything else. But every time I build up a transaction, I get cash back, so I can save money. So there are advantages. Some disadvantages, of course, you're going to pay interest if you don't pay it off, and it can be a high interest rate, especially when you're young because you're just getting started. There's fees and charges. If you miss a payment, there's automatically a late fee that gets tagged on. Some cards charge you just for the privilege of holding the card, others do not. It can be very tempting to overspend because it's super easy to pull out that piece of plastic and zip it through the machine, and you don't think about it, then all of a sudden you get the bill and you're like, oh my God, what has happened here? So you can get out of control. You have to be sure that you're very careful with it. And once in credit card debt, it is very hard to get out of debt. And I mentioned this last time, but never ever just pay the minimum payment. If you just pay the minimum payment, you're going to be in debt forever because it takes forever. The minimum payment barely covers the interest and maybe just a little bit of the principal, which is the amount of money that you actually borrowed. And so if you're just paying the minimum payment, you're going to be paying back for a long, long time, and you're basically just paying back interest, and you're not paying off the actual principal of the loan. If you can't pay it off in one payment, I would suggest looking at dividing it in half and paying it in 2 payments. That way you only pay interest for 1 month, or if possible 3, maybe 4. But remember, every time you subdivide it and you push out those payments, you're paying more interest every single time that you make a payment. Some common uses for credit cards, just household items. Like I said, I buy dog food for Luna, if you know my dog Luna. I buy gas for the car from the BJ's. I have a credit card set up so that I can buy stuff off of Amazon if I want something off of Amazon. And it's just, I buy some common household items, and then I just pay it off at the end of the month. Auto repair, because it never comes at a convenient time. It's always good to have some money available on a credit card for an emergency. In fact, that's the main reason why I think you should use a credit card, is for emergencies. If you need to rent a car, generally a credit card is required. And also airline and hotel reservations. Most hotels want a credit card, as do airlines. Now, can you get away with your debit card? You can. But just make sure, because what happens with your airline, your hotel reservations, is they'll put a hold on a certain amount of money. And if that's your debit card and they put a hold on, let's say $200 worth of money, that's $200 that until that hold is removed, no matter what you do, you can't touch that $200 that's on hold for the hotel or the airline, so be careful. And of course, online purchases, like I said, Amazon or, whatever that whatever you use to purchase online, it's just easier to do with a credit card. I went over some of the disadvantages, the high interest rate, the fees. It's very easy to get over your head, and it's hard to get out of debt once you get into debt with a credit card because of paying only a payment. Some advice, I said it once, but it bears repeating. Try to use credit cards for emergencies, especially as if you're young, because it's so easy to overspend. Always repay the full balance if at all possible. If it's not possible, divide it into as few payments as possible so you get big chunks of debt retired away, and not just pay interest over and over again. And pay on time every time. If you don't pay by the due date, you're going to incur late fees, and those late fees, they're usually $35, maybe $45, but that can add up. If you've got it like that, why are you using a credit card? Just pay for it. So be careful when you use your credit cards. Some general purpose credit cards, like I said, secured credit cards. It works almost like a debit card. It requires a deposit to be held by the credit card company, and the credit limit is the amount of money that you have deposited. So like with the Visa or MasterCard that you buy at the grocery store, at the drugstore, at Walmart, whatever, the prepaid cards, it's only good up to the amount you've put on it. So it's kind of like a debit card. However, it is good for starting a credit file or rebuilding a credit file if you experience difficulties, because it is a public transaction. Unsecured credit cards, you don't deposit money in advance. You pay money back as you borrow it. Credit limit and interest rate depends on your income and credit score. So the better credit score you have, the lower your interest rate. And generally, there's no collateral required. They're not going to come and get whatever you've bought, like with a car, an auto loan, or a home loan. If you don't pay, they're going to come get your car or kick you out of your house and foreclose, like we talked about last week. But with unsecured credit card, they're not going to come get what you want. They're just going to hound you with phone calls, emails, letters, and they're going to attack your credit rating and make it so that you can't borrow more money. So you just want to you want to make sure and if you create the debt, you've got to pay the debt off. It's only fair. Some store credit cards: Sears, Best Buy, BP, Home Depot, like I said, Lowe's, Macy's, whatever, insert store name there. A lot of times you get it and it's a special promotion. So, get a credit card today and get 10% off of what you purchase. It's very tempting, but then all of a sudden now you have 11 million credit cards at different stores. And remember, each one of those may represent a bill. So please be careful. Again, record keeping, it allows you to have a written record through statements of what you've bought. These are public transactions that helps build your credit record, and much like unsecured regular general purpose credit card, you get buyer protection. If you buy it through it has Sears here, and Sears is now in bankruptcy, but if you buy it through Best Buy credit card, Best Buy will stand by it, okay, and help you get, do better. So the disadvantages is, as we said before, it's only accepted at the specific store where it's issued. There's generally a higher interest rate on a store credit card than there is on a general credit card. There are fees and charges that will kick in, and just with a regular credit card, it's very easy to overspend. And just like before, once in credit card debt of any type, it's hard to get out of credit card debt. Common uses. Again, household items. Go over to Lowe's and get yourself some sort of equipment to work in the yard, or like a weed whacker or something like that, or get yourself a drill set, or go to Macy's and get a set of dishes or what have you, or clothing. Home repair and auto repair and fuel, like over at the BP station or the whatever. And some advice, just like with all other credit cards: repay the full balance if at all possible every month, and pay it on time to avoid any kind of extra charges. Some depository institutions: this is going to your bank or your credit union to get your loans, and this is it builds a relationship. The advantage is it builds relationship with a local lender. You go to your bank and now you have a banker that you talk with. It builds your credit record for a long, over time. Generally, a bank will give you a lower interest rate than a credit card company. So if you can, use a bank, it's not a bad idea. And it is the oldest form of credit, so it's established. Some disadvantages is it's harder to get a loan from a bank or a credit union because they have higher standards. And especially if it's a small loan. If you're borrowing from a bank, if it's under $1,000, they're probably going to tell you to get a credit card and go that route. Some common uses is purchasing an automobile, purchasing a home, or making improvements to your home, or other major purchases, such as, I don't know, if you're a young man and you want to purchase a very expensive diamond ring for a young lady to get engaged, it's gonna be over $1,000. I don't know, whatever. A boat, if you want a boat, motorcycles, jet skis, all kinds of things. Some advice to you about getting a loan from a bank. It's build the relationship with your banker so that they know you, so that they can, when they see you coming, they're like, oh, it's Gina, hey, how's it going? And they know you. It's not like you're dealing with a stranger every time, because this is a person you probably are going to have a reoccurring relationship with if it's at your bank. And only take out a loan if you really need it. There's no need to borrow money every time you turn around from your bank. Just because you have a credit line there doesn't mean that you have to take advantage of it all the time. Finance companies, different from banks in that these are usually smaller businesses. These are, let me see, I'm gonna look up, I'm going to just Google for a second finance companies because none come to mind right now, which is, I guess, a good thing. It's been a long time since I've had to deal with a finance company. When I was young and first married, we financed a fish tank. We wanted a big old saltwater fish tank for some stupid reason, and we financed it through a finance company. I told you I have made mistakes. Let's see, financehq.com looks like one. Let's see, payday loans. These are very dangerous. Fastloanadvance.com, veromoney.com, daysloan.com, graceloanadvance.com. There's a million of them. But anyway, I'm not going to waste all your time. You can look those up for yourself. I would advise you not to take advantage of those, because those are some people call them predatory loans, because they're so cutthroat. They're very easy to get. I mean, if you got a pulse and you got a paycheck, that's why they're called payday loans. They'll give you a loan. In fact, my bank will do that. The credit union will give you a loan against your paycheck. But then when you get your paycheck, what do they do with the money that they borrowed from you? When your paycheck hits, it comes right out of your paycheck and pays off your loan. You got to be careful with that kind of stuff. But that's what a payday loan is like. It's like if you get paid on Friday and you need some money on Wednesday, you're literally borrowing money until Friday, and they are charging you an exorbitant amount of interest. And by exorbitant, sometimes I mean 99%. So if you borrow $100 for 2 days, you may owe $200+ back. It's ridiculous. But it's easy to get. Some will specialize in specific areas. They will finance lower amounts. This is like if the bank says, oh, I'm sorry, that's too low of an amount of money. I'm not going to give you that much money. I need to, borrow more. A finance company will say, no, I can give you $99. I can give you, $250. Disadvantages, like I said, way higher interest rates and a lot of fees and charges. If you miss a payment, it's ridiculous. I'll talk about it in a moment. I have a credit card that works kind of like this that I'll talk about. Common uses is auto repairs, or something to do with your car, buying home furniture or major appliances. Home furniture places will do this. $0 down, zero interest for 15 months. okay, and they're financing it. But what will happen is, if you don't pay off the whole amounts, it's like zero money down, no interest, no payments for 15 months. And if you don't understand how that loan works, you're like, yeah, I don't have to pay anything for 15 months. Well, if you don't pay it down at the end of the 15 months, you owe your money, plus they go back all the way to day one when you borrowed the money and compound that interest. Remember, we talked about compounding interest last week. So it's like no interest, no payments for 15 months, but 15 months in one day, you owe everything. And it's blindsiding sometimes. So in fact, I'll go ahead and talk about it right now. I have a medical credit card called Care Credit, and I've used it several times when I needed to pay off medical things quickly. Most of it in terms of using it with my dentist. So let's say that it's the special that they're running with my dentist says no interest and no payment due for 12 months. What I did, and I'm doing it, in fact, I'm doing it right now because I went and had a big dental bill in December. I divided that amount up into 10 payments. And I'm paying it off in 10 payments rather than 12 payments, because right now, in that grace period, I'm paying no interest on the money. So I'm paying it back in increments. What do they want? They want like $50. But what am I paying them? A little bit over $300 a month. Why? Because I want to pay it down early so that 12 month doesn't hit and they go all the way back to December and charge me interest. So you can do it. And in fact, if you do it that way, it's free money and you're just paying it back. But please be careful with it because it's so dangerous. Shop for your best rate and terms. Don't just take, just because finance companies, a lot of times they prey upon the desperate. So just because you feel like you've got to have the money right away doesn't mean you don't have time to look around a little bit. And only take out a loan if you really need it. The Care Credit it's very good. You have a line of credit that you can use for it's usually for medical things. I can also use it for my vet bill if Luna were to get sick, knock on wood. I hope she doesn't need it. But you can use it for medical things, and then you just pay it back. They run promotions all the time, like through the doctor's office. The 12-month no interest was through my my dentist office. My vet might be running something where it's like 24 months no interest or whatever, and I have a little bit more time to pay it off. So you just do the math so that you can be smart enough to pay it back in increments that will let you avoid paying interest. And then it works to your favor. You can do it to your favor, but just don't get caught up and then end up owing a lot of money. So they do have a little chart in the PowerPoint and in the book that just compares the general purpose credit cards with the retail credit cards with depository institutions such as a bank or a savings and loan or a credit union, and then the payday loans. So please review that. I do love the fact that with the payday loans and the financial lenders, they say please use it as a last resort and only for an emergency. So because really that's the way it goes. A revolving line of credit, it replenishes up to a set limit when payments are made. So this is how normally a commercial credit card works, like a MasterCard or a Visa. So let's say the example on the PowerPoint and in the book, you have a credit limit of $1,000. Why? Because it's easy math. So you have a credit limit of $1,000, you charge $300. You can borrow up to $700, but you owe them $300. So you make a payment of $200. Now you can borrow $900 and you only owe $100. You go ahead and pay that $100 off. Now you can borrow the whole $1,000 again. So it's however much you pay back moves up how much you technically can borrow. It's a very simple idea. It's a revolving line of credit. As you pay off, it goes back to the good and you can borrow it again. It's like a revolving door. When you apply for credit, generally they want some demographic information such as name, birth date, current and previous address, social security number, phone number, and other personal identifying information so they can figure out who you are. What is your credit history? Do you pay loans back? Are you a good risk or a bad risk? How much income do you generally have? They want your income, Your employer, your employment and salary history, what does this go to? It goes towards, are you stable? Are you going to be able to pay back what you borrow? You are not required to include child support or separate maintenance payments or government support that you receive. So, for example, if you're receiving child support, you don't include that as part of your income, because technically that's for the child that you are raising. It's not really your money. However, if you do list it as income, the creditor must include that income when looking at your total amount of income. And if your income is too high, they're like, why are you even trying to borrow? So please be careful. They want your assets and liabilities. Usually, a lot of times it's only your checking, savings, and investment accounts and your outstanding loans and credit cards. However, some banks and lending institutions may ask for a complete balance sheet with all your assets, all your liabilities, and your net worth. And this is basically to see, can you repay the loan or the credit card bill when you borrow. They want somebody to contact just in case you skip town, and they will call that person. They identify. Well, I can't say the word identification this morning. I'm so sorry. They want the identification and contact information of a nearest relative not living with you. And basically, they will, if they can't get up with you, they're going to try to get up with them, okay, to try to locate you. And at the end of the application, you're going to sign it saying that whatever you've put on the application is true and correct. So they have what they call the 5 C's of the credit decision, and these are the 5 most likely reasons whether you either will or you will not get approved for credit. Your character. How responsible are you in repaying a loan? If this is your first experience repaying something, that's a little bit harder to determine. It's not going to be a disqualifying event, but it's going to maybe make your interest rate higher and your terms a little bit tighter because you're establishing your credit. Do you have enough income, your capacity? Do you have enough income minus expenses to pay a loan? What is your debt to income ratio? In other words, if you are leveraged up to the top where every penny that you get is going somewhere for a bill, you can't afford to borrow any money because you can't afford to pay anything else back. Collateral. Do you have something of value to secure the loan? We said with a home loan and an auto loan, the home and the auto are the collateral. With a credit card, there's no collateral. So character, what's your history? Capacity, do you have the money to make the payments? Collateral, is there something of value to secure the loan? Capital, net worth, other assets that could be sold to repay the loan. And conditions, what are the economic conditions for specific industries? It could be something that's completely out of your hands. In other words, it's just not a good time to borrow money. Something that we haven't mentioned up to this point in time, but is a place that you can go to get money. I put it on par with the payday loans. Is you can go to a pawn shop. The collateral when you go to a pawn shop is whatever item you take to pawn. So if you go to a pawn shop and you take a diamond ring, per se, to pawn, they keep the ring, you get the money, and there is a date by which you must have the money back to them plus whatever interest that they want. And if you don't get it back to them, then what do? They sell your ring. And it doesn't matter if you're 1 day late. They could put your ring out for sale as of the date that the loan, is due at the end of the day. So let's say you show up, let's say your loan is due at 9 p.m. on a Tuesday and you don't show up till 8 p.m. on Wednesday. They have put the ring out for sale on Wednesday morning, and it could be sold by Wednesday at lunchtime, and it's too bad. Sorry about that. So please be careful when you're dealing with pawn shops. Okay, they're the last of the last minute options. I'm not saying don't do it, but I'm just saying be careful with it. Okay, so 5 C's. Back to the 5 C's. Character. Are you responsible? Capacity. Do you have the money, or is all your money leveraged to the point where you can't afford to borrow anything else? Do you have something of value to secure the loan? Collateral. Look, the sun is coming out. Capital. What is your net worth? Do you have something that could be sold to pay the loan off if necessary? And just general economic conditions. And they have a sample debt to income ratio calculator worksheet for you, both in the PowerPoint and in the book. And we talk about risk. The higher the risk of not being paid, the higher the interest rate charged to offset the risk. It's determined by those 5 C's we just talked about. If you have a high income, your risk decreases. It's ironic. The more money that you have, the less money you have to pay to borrow, because the more likely it is you're going to have the money to pay it back. If you have collateral, your risk decreases because they can get your collateral and take it. If you have a lot of capital or a high net worth, your risk decreases and the rates are lower because they've got something that they can sell to get rid of to get the money back. But if you don't have a lot of money, if you don't have anything you can use for collateral, and if you don't have a lot of net worth, in other words, you really need to borrow the money, you're probably going to end up paying more in interest and fees because you're a bigger risk. First credit card was established in the 1950s with the Diners Club. I hadn't heard about Diners Club in forever. In 1958, American Express and Bank Americard, now Visa, entered the market. And this is 2016 numbers. And remember, the book asks questions based on data from the book. So in 2016, average household credit card debt was greater than $15,000. Average undergraduate credit card debt greater than $3,000, and average college senior credit card debt greater than $4,000. Just for fun. Average consumer debt in America 2025. Average consumer household debt in 2025. Total household debt, this is aggregate for all Americans, $18.036 trillion. Jesus. With a mortgage debt comprising 70% of that money. Credit card delinquencies, meaning what? You're not paying your credit cards back. Delinquency rates are increasing, reaching levels not seen since 2008. Well, 2008 is a big benchmark because 2008 was the last time that we had what was considered a recession. Auto loan debt, total auto loan debt stands at $1.665 trillion with an average loan debt of $24,326. So, wow. So the aggregate, like I said, was $18.036 trillion and an average of $105,056 per household. So in 2016, so 9 years ago, they're saying the average credit card debt was $1,500, so that doesn't include the house and stuff like that. But $105,056, that is a lot of dollars. Average credit card debt, $6,380, up from $15,000. Oh no, down from $15,000. Okay, so credit card's down, mortgage is way up. You can look this up literally. In fact, I will go ahead and include this as a supplemental part of your module this week in the supplemental information. Let me go ahead and put that in there while we're talking, or else I'll forget. Supplementary resources. So this is the website is called The Fool, which is part of the Motley Fool, which is the Motley Fool Money. Although they have the title The Motley Fool, they are very well thought of in terms of financial advice. So I'm going to add that so you can see it in the supplemental information that's for this week. Pretty cool. So anyway, so credit is up. About borrowing is up. It makes sense that it would be up when we start looking at total debt. So some advantages of doing credit cards. We've talked about it before. You have consumer protection or arbitration options. Automatic bill payments, you can set it up to pay every month on a particular date. You have some identity theft safeguards, which we'll talk about in Chapter 6. It builds your credit. You can get extended warranties through your credit card. You can get interest-free loans if you pay it off every month, or like I'm doing with my Care Credit, pay it off in time. You get purchase protection, rental car coverage, and rewards such as miles or cash back or what have you. Features of credit cards: there's a credit limit that you know how much you can borrow without penalties. There's a grace period, usually 30 days. So like when you get the bill, you have a certain amount of time before when you receive the bill to when the bill is due. And that you do have, now not all credit cards give you a grace period, but generally they should, because you have from the time you receive the bill. It would be really weird for you to get the bill and have it due the same day. But whatever. There is an interest rate no matter what. They're going to charge you interest, not like grandma or grandpa or whoever, auntie or uncle or mom or dad. It can be fixed or variable based on an index rate, and your credit card must tell you if there is a change, and it can be very high for some credit cards. In the finance charging section, the credit card charges, they have what's called an adjusted balance method. Payments or credits received during the current billing period are subtracted from the balance at the end of the previous balance period. So it's like you're charged interest on what you owe at the end. Remember that revolving door that we talked about? The average daily balance method is the most common method. What they do is they just take what your balance was every day during the period and they average it. So it depends on when you make the payment, how much you're saving. So if you don't make the payment until a couple of days before the average daily balance method is calculated, that payment is going to carry less weight than if you made it near the beginning because of the compounding. I went backwards, I'm so sorry. Minimum finance charge is the minimum interest that is charged per billing cycle. So you'll see that a lot of times on your bill, it'll go minimum finance charge if you carry a balance $5, or something percentage of what you've borrowed, okay, depending upon what your percentage is. And if you have no balance, the finance charge is 0. That's why I like to pay it off. So some credit card fees that are, there's a chart. The annual fee can be charged once a year or monthly for having the card. Some cards don't charge you an annual fee, some cards do. It just depends on the card. That's one of the things you need to look for. Cash advance fees, if you use the card to buy something, that's one thing. If you use the card like it's an ATM card, because you can take your card to an ATM machine and borrow money and just get cash, but there is a cash advance fee. And no matter the amount of the cash advance and percentage fee for the cash advance, it can be two separate things. So like it could be like, let's say $500 per occurrence, $5 per occurrence, and then a percentage of what you borrow. So 5% of what you borrow. So the example is 3 for a credit card that has a cash advance fee where it's a $5 flat fee plus a 3% on the balance. So if you were to take $500 cash advance, that's where I got the $500 earlier, you would be charged a $5 flat fee plus a $15 percentage fee for a total of $20 to borrow the $500, to get the $500 cash out. Some people go, okay, that's cheap, but understand that's money that you have to account for when you're budgeting. A late payment fee, if you miss it by 1 day, they're going to tack it on there. They really don't care. Most are between $15 and $39. And it may affect your interest rate, because if you're not paying on time, they're like, oh, this guy or this girl is a risk, and we're going to raise their interest rate. Over the limit fees, if you for some reason exceed your credit limit. Now what they'll do, like let's say you're bumped up against the credit limit of $1,000 and you're sitting at let's say you've borrowed $950 and you buy something that's worth $75. What they're going to do is they're going to go ahead and let you spend the $75, and then they're going to charge you over the balance fee for the $25 that's over the balance, over your limit. Typically $15 or more, depending on the credit card company. Please understand, you have to read. There's a whole big thing of paperwork that comes with these credit cards, and you have to read it to see what applies to you. Returned item fee. This is if you bounce your payment. So let's say you try to pay with your debit card or whatever, and it doesn't go through. Your payment, this is in the old days when they had checks, they would be returned to your bank, put a hold on your account. Like let's say you send it in on time, and then you go, oops, I can't do that, let me stop that payment. Okay, now you're going to get a returned item fee from your credit card, plus your bank usually charges you for that as well. That's a risky business. Balance transfer fee. If you bring, let's say you consolidate 2 credit cards and you bring a balance over from another credit card, they charge you a little bit for that, 1 to 5%, depending upon the card. Sometimes you'll get a special that says 0% transfer fee for if you pay it off in 6 months or less. That's the same as my Care credit card that I talked about. As long as you can use that to your advantage, as long as you divide that payment into 5 payments and pay it off before the 6 months is over. Any other fees, you just need to read the fine print, because God knows what they could do to you. Not reading the disclosure is your fault, not their fault, because they'll say, well, we did it. If you didn't read it, that's your problem. What happens if there's an error on your statement? There is a law called the Fair Credit Billing Act, and if you notify them within 60 days after the statement day that there's a bill with an error on your bill, or send a letter to billing inquiries, or nowadays really it's done on the internet more than anything else, go to their website, get your name and account number, tell them what the error is, why is it an error, the date of the error, and if you have any kind of supporting documents, like let's say that you have a receipt for, you went to a restaurant and the bill was $45 for the food, and you put a $10 tip down, making it $55. And then somebody, I don't know who, we don't know who, but somebody changed that 1 on your $10 tip to another 4, giving themselves a $40 tip. If you have your copy of it where you've written in that there was a $10 tip, and you have the receipt and everything like that, you could have them investigate and find out what's going on, because they'll pull the actual receipt from the restaurant or what have you and see if it's been tampered with. Now, there's a chart there about choosing the credit card. Just like we ranked different lending institutions, you can use this to choose a credit card, and some tips for keeping your credit card and rates and fees low. Use the card wisely, pay it on time, maintain a low balance. Look out for new fees. Always watch it, because they'll send out an update that says, hey, we're changing. It says be judicious. If you are not paying your bills in a timely fashion, they may raise your rates. So be careful. And complain if your fees spike without you doing anything to warrant the change. Call them and ask them and say, hey, what's going on? You might even, now don't threaten something that's not true. But if you've gotten an offer from another credit card that says, hey, I can transfer the balance to this other credit card, and they're going to do this, this, and this, can you match it? A lot of times they will, to keep you as a customer. Or they might say, go for it. That's up to you. So please don't start lying. Tell them the truth. Student loan categories. Many of you may have borrowed money for student loan. It's usually made directly to the student, a federal student loan. You can also have what's called the Parents Plus loan, where your parents take out the loan on your behalf to use for your school. Or you could get a private student loan that can either be made to you or to your parents. The FAFSA, free application for federal student aid. Understand that it must be completed every year. Just because you do it once doesn't mean it carries over from year to year. You have to do it every year. And that is all up in the air right now. I understand. I'm dealing with paying back student loans myself, and it is crazy right now, but just do what you need to do. Subsidized versus unsubsidized federal student loans comparison table. We talked about the risk with the accrued interest last chapter. It's kind of the same thing this chapter. I think it's basically the same graphic. The main difference is a subsidized federal loan, the interest is does not kick in until after you graduate or drop below half-time for 6 months. And with unsubsidized loans, it's ongoing the whole time. Some things that you might want to look at is consolidate and refinancing. Get one lender and one rate for all your student loans. I get stuff all the time about refinancing my student loans, and right now mine are through the federal government, and they are, some of them are subsidized, some of them are unsubsidized, and so I'm in repayment, and you know, it is just one lender and one rate, and you could refinance it through a private, but just be careful about what your interest rate is. And also understand that through private student loans, there may be some relief packages and payment plans available through the federal government that would not be available through a private lender. So just be careful. You can defer if you find yourself in a situation where you can't pay the loan. Let's say you got fired or you haven't found a job yet. You can let them know, hey, I want to defer starting to pay back. If it's a subsidized loan, the interest will not accrue. If it's not subsidized, the interest will continue to accrue. Forbearance, much like deference, is you can postpone or reduce payments for a specific time period, but the interest does continue to accrue. Now, what is the difference? Why would you choose forbearance over deferment? You can only defer so many times, and you have to go to forbearance. And then you can choose alternate payment options. Like I said, there's payment plans. There's, you know, all kinds of different options where you could get private loans or what have you to pay back your student loans. So it's doable. It's just sometimes navigable is kind of different. You just have to be on top of everything. You have to be in communication with your loan provider all the time. Standard repayment is a 10-year payment plan, $50 minimum payment. Extended repayment, you can extend it out. Usually they will not exceed it beyond 25 years. And for this to extend out, minimum loan must be $30,000. I laughed at the $50 minimum payment because I don't know of anybody that would only have $50 as a minimum payment, but here we are. You can also do what's called a graduated repayment. These are some of those alternative payment options that we were discussing. You can start out low, and over the course of 10 years increase every 2 years, with the idea that every 2 years you'd be making some more money. And we also have income-based repayment, which is what I'm under. It's based on income and family size. Every year you must submit annual documentation of how much money you make to set the payment. So it would change every year based on the money that you make. And then there is a chart that kind of shows you, like, a standard payment is a flat fee. A graduated payment starts out low and goes higher, and they show it looks like stair steps. Extended fixed, it stays flat, but you pay for a longer period of time. Extended graduated, it gets bigger over time, but you pay for a little, you pay a little bit more every 2 years. Income-based repayment is blank because it depends on how much money you make. income-based repayment for new borrowers. They come up with some kind of a crazy grid there. Pay as you earn is somewhat like income-based repayment. It goes up and goes down depending upon how much money you make. Income contingent repayment is, again, it's variable. Something that they did not list here that I'm involved in is the Public Service Loan Forgiveness Plan. And the way that that works is if you take a job where you are a public servant, either for school that is not for profit, like Methodist University is a private university, but they don't operate for profit, so they qualify. Or if you work for the public, like K-12 schools, or somehow in government, like a federal, state, local government, it's a public position. Like if you wanted to go to law school, and rather than going into private practice, you work for the district attorney's office. The assumption is you're going to make less money than if you were a private attorney. And so as a thank you for giving up the money you could make as a private attorney and taking the salary of a public defender or what have you, or district attorney, they lower your payment. And that's why I did the income-based repayment plan. They lower your payment, and at the end of 10 years, no matter how much you've paid in, as long as you have made your payments on time, 120 on-time payments, never late, and you can apply for the rest of your loan to be forgiven. So that's the situation I'm working through personally, because I'm working as a professor and making way less money than I would have had I gone into private business and became an upper level manager somewhere with a corporation. So so that's the gig that I'm trying to work on, is the 10-year payment plan. So I'll let you know how it goes. I'm still paying it back. So they do have the calculating the payments, which is the value, the present value of a payment over an annuity. We talked about last time over the annuity. It's that same equation that we did last time, and they have some examples of how much to pay. They have an amortization table, which is, gives you the interest paid, the principal paid, and the ending balance paid. And just a little statement that says, it can be costly. Payday loans, title loans, rent to own, it's under the thing called costly cash. There's a type of lending that's that goes all the way back to the Bible. It's called usury, U-S-U-R-Y, and state laws usually have a law that states usually have a law that specifies the maximum legal interest rate at which loans can be made. And if you go above that, it's considered usury, which is illegal. So be aware of what your state's law is regarding a legal interest rate. The Predatory Lending Act is when you lend money at an unreasonably high interest rate, making repayment excessively difficult or impossible for the borrower. Where does this come into play? Usually it comes into play when people are desperate and they go to places like loan sharks. And I know you see them in movies, that doesn't really happen. Oh yes, it does. Or they go to these payday loans or title loans or rent to own places, and all of a sudden they find themselves in such a mess that they can't pay the money back. So please be careful. And predatory lending, there are legal remedies for it. Payday lenders are generally short-term loans, normally about 2 weeks, because most people get paid, at least twice a month or once a month. You write the payday lender a check for the amount you want to borrow plus a fee, and you date it. This is normally how it used to go. Nowadays, that when people aren't using checks, it's more like a credit card transaction. But if the date due comes and they try to cash the check and it's no good or whatever, or the money doesn't come in as an automatic payment, there's a rollover fee. Annual percentage rate, including the fees, can be 250% or higher, because it's 15% every 2 weeks. So the example is 15% every 2 weeks equals 390%. So they are hugely predatory. That's why I said please don't do it unless you have to. Title loans, title of a vehicle is collateral for the loan. It's usually, typically, this is like if you have a car and you've paid it off and you're like, I need to borrow some money. Let me get a title loan against the car. They'll say, okay, well, your car is worth $1,000. I'll give you $250. Why? Because that's easy math. It's usually 25% of the value of the vehicle. It's a short-term loan, and if you don't repay the loan at the high interest rate, like a payday loan, they're going to come get your car. They'll come repossess it. Rent to own, we've talked about, that with furniture. They do so with houses as well. You make purchases with low weekly or monthly payments, and it's usually interest rate is usually very high. However, read carefully the agreement. If you can get so many months for free, calculate your payments so that you pay it off before the interest kicks in. So, some alternatives to payday loans. Try to contact a credit union or a small loan company and see if you can get a personal loan. Dealing with a bank is going to be safer of any sort. Look into a cash advance on a credit card. Remember, we said it's going to be a little bit of money, but it won't be like predatory levels. Shop the credit offer with the lowest cost. Make sure you're being smart about it. If you've got to go that route, get the lowest amount of interest and all those kind of fees. Contact creditors and ask for more time to make the payments or to temporarily pay only a portion of the loan or just the interest. A lot of people don't think about this, but the credit card company would rather hear from you and know what's going on and say, look, I'm sorry, I can't pay the whole amount, but I can pay this month. I can pay this much. Can you work with me on it? Rather than you ghost them and they think, what, you're skipping out. So don't avoid talking to your creditors. Be honest with them. They'd rather hear from you than not. Ask your bank about its overdraft protection for your checking account to keep from bouncing checks or having overdraft for ATM withdrawals. See if you can get a paycheck cash advance from your employer or emergency community assistance or borrow from friends and family. If it's an emergency, go back to friends and family and say, hey, I'm in a mess. Can you help me? So that's chapter 5. Chapter 6, credit bureau reports and identity theft. And this may be as long as the other one. I'm sorry, but I'd rather have it for you than not. There's 7 learning objectives. But we're going to talk about the importance of credit and how to establish personal credit. Talk about credit reports. Talk about your FICO score. And talk about strategies to help with your FICO score. Talk about correcting errors on your credit report. Talk about identity theft and how does it occur, and employ steps to minimize credit risk at your different stages. The perfect credit score, it's not a unicorn, it does exist. What would life be like if you never used credit or had a credit score of 0? No credit is almost as bad as bad credit because now you're an unknown quantity. If you've never used credit, how could you buy a house, a car, or a college education? How is having a high credit score a ticket to debt? Which it's not necessarily a ticket to debt. It's kind of a ticket out of debt. I don't like that. And credit is not bad, but you need to use it properly. It's a skill just like anything else, and your good credit score is a significant asset. So establishing your credit, you need to do it while you're young. I would say the way that a long time example is go ahead and get you like a gas card or a store credit card, something where it's got a low amount of money that you can get in trouble with, and you use it wisely and pay it off every month, and you start to establish a good credit report. Okay, perfect credit score I believe is 850. Hit my hand on my desk. Let's see, credit score. Let me double check so I don't say anything wrong. Credit score chart. I use Credit Karma, Credit Karma, and I check my score fairly regularly, and I have found it to be a good tool It doesn't show you all 3 of your credit reports. It shows you 2 regularly, but that's good enough. And you can get a free credit report from the government once a year at no charge, and shows your full credit. So it's not, let's see, it's not showing me what I want to see. Credit score chart. Okay, so this is from My Bank Tracker, and it says the range is from 300 up to 850, and it's based on payment history is 35%, amount owed is 30%, length of credit history is 15%, how much new credit is 10%, and the type of credit is 10%. So if you're from 300 up to 560, it's in the red zone or the very bad zone. Okay. If you are 560 to 650, it's in orange or bad. It's 650 to 700 is yellow or fair. 700 to 750 is light green or good, and anything above 750 to 850 is considered excellent. So, see, I'm gonna pick up my phone and see if I can. I don't know how to turn the camera around. Hold on. Never mind. I was going to turn it around and see if I could, flip the camera and show you this thing. But anyway, it's My Bank Tracker. You can look it up. So with the credit scores, depending upon what your credit score is, that is one of the C's of establishing credit. As we said in chapter 5, you need to pay off the credit cards in full if at all possible, or in big chunks. Please don't just pay the minimum balance. If under 21, according to the Credit Card Act of 2009, you must show some evidence of income or have an adult cosigner to qualify for a credit card. This law prohibits credit cards from encouraging college students to apply by offering free gifts, and a credit card company has to be at least 1,000 feet from campus to offer incentives. In the olden days, let me get my cane out. When I was your age and in college, there'd be like a tabling event near the student center or somewhere, and a credit card company would be sitting there saying, "Hey, come and get a credit card with us," and that kind of stuff. And people got into a lot of trouble with them. There are 3 national reporting agencies. There's TransUnion, Equifax, and Experian, and the PowerPoint includes a link to all 3. They make a credit report that's available to lenders. The lenders will send them your information, and they will give them a history of how you're doing. Some information on the credit report includes the name of creditor, who have you borrowed from, their address, phone number, and the account number, the type, terms, and monthly payments, when was the loan opened, when was it last reported that you owed money, what is the credit limit or original amount and high balances, any recent balance and required payment, any comments on whether you've done well or done poorly, and what is your payment history for every debt that you have borrowed. And they have a copy of a sample credit report. Looks kind of like, they still kind of look the same. Your FICO credit score. FICO is an acronym that stands for the Fair Isaac Corporation. FICO, Fair Isaac Corporation, developed in the 1980s, and is a snapshot of your credit worthiness. And this is the range that I said, 300 to 850, the higher the better. It's supposed to predict the likelihood of you declaring bankruptcy. Anything below 640 is considered not great. And here's a comparison of FICO scores by age. Different colors for different age groups. And national distribution. Remember, this is old data. So if you want something newer, just Google it. I mean, it's out there everywhere. Drivers of your FICO score, the biggest chunk is how on time do you make your payments. The sun is coming out again in my office. History of timely payments is 35% of what your score is. How much do you owe relative to your available credit is 30%. What does that mean? That means that if you owe 50%, if your available credit is $10,000 and you're $5,000 in debt, you're using 50% of your credit available, and that's not as good as if you were only using $1,000. So that's a 30% part of the decision is how much are you already in debt to what you could borrow? How long have you had a credit history? 15%. You know, if you're just getting started, you don't have a proven track record like if you've had credit for years. And what type of credit are you talking about, and what kind of new credit have you just done? Usually, like I bought a car last year, so on my credit report it shows where the car dealership looked at my credit, and that will go away after 2 years, and it won't matter anymore at all. But right now it's a little bit of a factor on my credit report. They do show the range of credit scores and how to improve it. Review your credit report. I don't work for Credit Karma. There's other ways to do it, but I have found them to be very easy, and they're free. And they give you updates. They'll send you like little emails saying, hey, something has changed. Take a look at this, that kind of stuff. Credit cards will also do that for you. My BJ's credit card will also do that for me. So it just depends on what you're doing. As many as 25% of credit reports contain errors, according to the Federal Trade Commission as of 2013. I'm sure it has not gone down, affecting as many as 40 million Americans, CBS News 2013. You can go to the website www.annualcreditreport.com, and you can receive a free credit report from all 3 credit bureaus one time a year. You can do it more often, but they will charge you if you do it more often. But please be cautious of free credit reports, which might sign you up for credit monitoring service. But if you do the annualcreditreport.com, you can look at and see if there's any errors, and then work to fix them. So to improve your credit score, pay your bills on time. We talked about this last chapter, but it's so important. Pay your bill as soon as you get it. Set up automatic bill payment through your bank or creditor's website. Have automatic payments for all your loans. That way you set it and forget it. Don't worry about it. That way all you got to do is make sure you don't overspend your cash, so that when it goes through, it goes through. Keep your credit card balance low. They like less than 30% of your available balance, and pay off debt versus transferring the balance. Limit the number of new accounts. Try not to keep opening credit card after credit card after credit card, but also keep your old accounts active. If you pay it down, that's fine, but don't close it, because that takes it off of your credit history. If you've missed some payments, fix it. What's done is done, but catch up on any missed payments. And we do have a website for the National Foundation for Credit Counseling. Please look to them if you're having issues, and Consumer Credit Counseling Service. To correct your credit report, if there's an error, contact the credit bureau in writing. Include copies of all documentation that you have as evidence. The Federal Trade Commission will provide sample dispute letters so that you can use them as templates. They will investigate the error within 30 days, supposedly, and the credit union will give you the results of the investigation in writing, and a free copy of your credit report if your credit report changes. If it doesn't change, there's no need to get another copy of your credit report. It's the same thing. And we do have a sample dispute letter listed in the PowerPoints. Adding accounts to your credit report. Not all companies report to the credit unions. Some small buy here, pay here companies will not show up. Write the credit bureau to add the account. Why would you want to add the account? Because if you're trying to build up your credit and you're paying on time, you want that to be seen, okay? They may charge a small fee to verify the account. What if there's negative information on there? Well, late payments and negative information, if you're not paying on time, late payments will stay on your report for 7 years since the date of last activity. So if you had late payments and you pay something off, for 7 years it's going to show up that you paid it off, but you had late payments. Unpaid judgments. If you have if you get something written off, 7 years or until the statute of limitations runs out, whichever is longer, from the unpaid judgment. Bankruptcy, normally 10 years, and if it's a criminal conviction, it's usually on there forever. So please be careful. Like I said, the hard pull on your credit where I bought the car, it's usually 2 years, could be 3 years, but it's usually 3 years is as long as it would ever go, but 2 years is normal. And that's not necessarily negative. It just shows that, hey, they checked your credit. Identity theft, it's a concern for everyone. When someone steals your personal information to commit theft or fraud, it happens all the time. And the more that we use online banking, the more common it becomes. They have scammers or skimmers, excuse me, that they use at like if you use gas stations to stick your card in. There's all kinds of crazy machines people use at point of sale where they put a little cover over the point of sale machine at the grocery store or whatever, and it steals your information. There's even small machines that people could have in their purse or in a bag, and they just stand near you. When you pull your credit card out, they can steal your credit card information. It is crazy out there. So basically they clone your card and they pretend to be you to get a credit card or a loan. If you're still using checks, people could steal a check and write a check from your checking account. This old data says that 9 million people are victims annually, and it can happen to anyone. And there's a link to the Federal Trade Commission website about identity theft. How do you protect your identity? Well, you got to monitor your credit report. I told you the other day with chapter 3 or 4, with chapter 3 with the bank, I have it set up with my bank that if a payment of $50 comes out of my banking account or my whatever credit card or whatever, I'm getting notified of it, and that way I'm right on top of it right then. Don't give out your personal information. Buy a shredder and use it to get rid of personal documents with all your information on it, so that you're not just throwing it away in the garbage can. Try to use mobile payment apps whenever it's possible, like PayPal and stuff like that. Protect your mail. Either make sure that you check your mail every day. Normally, don't just leave it sit in the mailbox, or get a P.O. box. Make sure you have proper security on your cell phone, because a lot of us do banking and stuff through our cell phone. Same thing with your computer. Protect your PIN whenever you have to enter it. Put your hand over it or something. And if necessary, freeze your credit report if you feel like you are having a problem, okay? If you are a victim, contact all 3 credit bureaus, follow up in writing, let them know what's going on. Review your credit report from all 3 credit bureaus, contact your local police, file a report, contact your creditors, file a complaint with the FTC, place a freeze on your credit reports, because then they can't pull your credit and try to get loans. That's why you want to freeze your credit reports. And monitor your credit reports to see if anybody's trying to get credit against you. The life stages of debt management. When you're a child, up to age 16, you generally don't have debt because you can't legally sign a contract. It's illegal to contract with a minor. At the independent life stage, you're usually starting with debit cards, credit cards, maybe a car loan, getting some student loans like going to college. Start monitoring your credit report and buy and use a shredder. At the early family life stage, make sure that you try to get your FICO score above 800 if at all possible, because you're wanting to what? You want to borrow money to get a home, probably buy some more cars or automobiles. You may want to go to graduate school and have to borrow money for that, and always monitor your credit report. In the last 2 stages, empty nest and retirement, protect your credit card and your identity. Always protect your identity. I don't know why they just waited till then to put that in there. Keep monitoring your credit reports and freeze your credit report if necessary if you are experiencing difficulty. So that is chapter 6. So that's so just to recap for this week, chapters 5 and chapter 6, the quiz for chapter 5, the quiz for chapter 6, the group discussion. It's about credit scores this week. The problems for chapters 5 and chapter 6, the chapter quizzes for chapter 5 and chapter 6, and the continuing case study for chapter 5 and chapter 6. And next week we will look at chapter 7 and 8 and take test number 2. The sun is out, and I will be back to you soon. Thank you. Goodbye.